The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Hi everyone, I finally got it right. I usually start talking when the announcer says Larry Pesavento and I start talking, and then all of a sudden I hear, and now Larry Pesavento, and it's like a little coda that I never remembered to wait for. I did remember today. So Basil Chapman sitting in a game for Larry, and Larry is right there, but he's still got that problem with his voice. I am going to be the ventriloquist today. I'm going to do my very best. There's my little puppet. Let me get my little sock and I'll say, hi everybody. So this is what we're looking at here. The Dow is up, is down 27. The S&P is now up 13 cents. Earlier this morning, let me just show this to you. Oops, am I going to mess everything up here? I've got Larry's charts already, but I just wanted to show you that in the E-mini futures in the 120-minute chart, from the 1352.50 low of the 10th of April, there was a quick peak A. Remember, in my methodology, I look for the lowest, most identifiable trough, and then see if we can count a peak A, a higher peak B, a higher peak C, and a higher peak D. Now, this has got nothing to do with AB equals CD. This is back in the 1980s when I was really developing this. I used to call it the Chapman wave, 7 waveform, until I found out that it could actually go to 9 waves or more. So I called it the just under the auspices of the Chapman wave. This is what we can get. Peak D is where you've got to be somewhat careful, because that's where you can get the deepest corrections. Well, that's exactly what happened back on the 12th of April at 1388.50. It pulls back to 1360, has another run up, and it gets only to a peak C minus. Usually very negative to fade at a peak C minus, but because it never broke the 1352.50, it could be called a peak E, an alternative wave. That's what I teach as well. You've got to be ready, have the flexibility to be able to look for alternative waves. Say 1390, back on the 19th of April, market, the E-minis pull back again. They go down to 1354. A trough D on the downside, their troughs on the 22nd of April, and then starts a fantastic move that makes 2 complete buy modes. And then, actually, there could even have been a third. This peak C minus that I have here could have been a D. But it doesn't matter. What happened is it ran all the way to 1411 on the 1st of May. And that said, look at the mini cap, a small arch formation, a larger arch formation with a slightly higher high, but a higher low. That was important. And then a much bigger one from the 1354 level, which is above 1352. If you're looking at Tiger TV, you'll be able to see that. Now, what's really important about this particular formation is it makes a very large one from the 1354 level all the way to 1411.75, and then comes down very quickly in a bear phase. And this little pattern right here is exactly the bear phase of the 1987 crash daily, the daily chart of the 1990 Nikkei chart, daily chart, and the monthly chart from 2007 down to the 2009 low. Not the daily or the weekly, but the monthly chart. That same thing, when you come back, you make the right arm failures, and you break with the dreaded H, and you come plunging down very quickly. That's what happened going into last night down to the 1340 level. It's run up now. The E-mini has run up to 1366.25, back into the arch. This is very important in my work. It goes back into the arch. This is where the real test of strength will come. If the E-minis by the end of the day is able to get another spurt of energy because the volatility index, the VIX, is pulling back, that says be careful, because what you need to see is that 1369 to 1371 area. That's critical. On a weekly basis, that is intra-week, on a daily basis, the 1383 will be huge if it's able to get there and break above it this week. If it fails, it makes an arch formation and even gets back to 1351 to 1349 today or tomorrow. That is not good action at all. So I've covered that. Let's go straight to what Larry was looking at. Now, Larry sent me a chart here. I'll do the first one. You'll be able to see this right here on my... Oops, come on. Click, click. Oh, boy. Let me try this one here. Click, click. Okay, that says I've got to just move this away. What am I going to do? I need to get that chart back. Click, click. Worked before. All right. What I will do is just for the moment, oh, this could be a big mess. There it is. The Dow chart, this is Larry's work, and right here it shows you the Dow Jones, and that red line is the Bradley model. So it's called red line is Bradley stock market model. This is Larry Pesavento's chart. And what he's showing is that there's a pretty darn good correlation between the general trend. You don't have to go for exact price movement. It is the trend. If I'm incorrect, Larry, just correct me at any point, and I will just quote right there. I'll quote the correction. But so far, that's what he says. And then the trend says that from round about March or so, there should be a downtrend. It allows for a bump up, and that bump up was the spike that made the new recovery high in the Dow. That was May the 1st or 2nd. And now what we've done is we've come back down, and now you can see we're underneath that trend line. This trend line says that the Dow should have made a pretty significant top with this triple. Look, this could be called a triple top right there. And or in my work, it also looks like it could be a rectangle formation, just trading, using up time. But no matter what, his work says that it should go down to test the 12,700s. And this chart, if I remember correctly, extends. Can I do it here? Yeah. No, it extends lower over a period of time. So this would be a pretty significant top in the Dow. That's Larry's chart, right? That's using the Bradley model. Now, what I'd like to look at, let's get rid of that. Now what we've got, sugar futures. Sugar futures he's got as a gap. Let's see. So it made a beautiful, there's 1, 2, 3, Gartley formations. Now this particular one says that having reached the high in sugar of 26 point, around about the 26 area, there's a significant pullback, and the support that is absolutely key to hold will be the support of May. Let me, if I can, I'm just going to go to my chart, just so that we're comparing apples with apples. SB, I don't know the contract. I think it's N. Let me go to N. I think I did K, and I don't think K's trading anymore. SBK, yeah, I did the May. It doesn't matter. Chart pattern is a chart pattern. Even though people will be trading it, the chart pattern should look pretty much the same. Now, what's interesting with Larry's work, I've got a peak E in sugar. This is the May contract. I'm not sure it's trading. Well, it seems to be trading today. What's the date today? No, 4:30. It's not trading. Okay, this is up until the 30th. But I just want to show the chart made a peak E top, and the stochastic MACD made a little double top, and the stochastic was way less at that peak E with a doji. It plunged underneath the up channel support and has come down with a doji. So I'm going to go to July, SB. Oh, yeah, good. And JP Realty in the den says it is July. That's LMN. So I'll go to the July. Oh, I did the July. I'm sorry. I'm with us. That says that you've got A, B, C, D, E, and a trough F, just like at peak F. You can get a bounce, and that bounce needs to have legs. In other words, sugar, if sugar, I'm going to use what I see on Larry's chart. If sugar takes out the low of the left side low bar, it's already done that. Sugar took out the left side low bar of May of 2011. That, in my work, says, I haven't got the notation yet, but it's pretty much the same notation as you saw on the May contract. That says if sugar was to close this week under 20.50, I've got 19.79 as a very important 200-period exponential moving average. Look at how that will support all the way through 2009 and through 2010. So to me, that would be really important. Let me go back to Larry's chart because I want to check to see. There it is. Okay. Let's get out of that. Okay. So Larry's chart has got us gapping below the 0.76 support and pulling back, and pretty much, yeah, it's the 20. I would say 20.28 would be a very key level on the sugar in this particular contract. So far, the weight of evidence says it could have a bounce, but it's going to have a significant turnaround to be able to stop the selling, because the selling is pretty intense in price movement straight down like this. So even if it had a bounce, it'd have to do a retest. If that retest breaks, got to be careful about that left side low bar. So I think I'm correct in talking about it in terms of the chart pattern that I'm looking at, and the 22.83 level is where the gap is. If it gets into that gap in the next 3 to 6 trading days, how it handles the gap is going to be very important. If it fails to get to the top part of the gap, that is the gap down, the low bar that is, that's going to be very important. If it breaks into that bar, that'll say, wow, there could be a price change coming in sugar. Now let's go to the chart that I was looking at before, and that would be right here. I want to go through all Larry's charts. Oh boy, have I got that correct? Now, how am I going to find that chart? Is it behind you suddenly? Oh, maybe it's behind there. Oops, I think I just messed it up. I'm sorry, my engineer. I had all these charts. It was working so beautifully. Now, let me do this. I'm going to go back. I must get Larry's chart. Okay, here we go. Spot on. T notes that I want to show these charts. So there's going to be a break coming up in a few moments. I'll mess around during the break, but first we'll go to Mike in New York. Hi, Mike. How are you?
Good. How you doing?
I'm doing well. You'd like to look at?
Well, okay. Here's my question. I was watching Bloomberg television a couple of weeks ago.
Yes.
And a housing analyst came on, and he said from May to July, for the last 7 years, you've gotten a 23% sell-off in the housing index on average. I wanted to ask you whether you would sell the housing stocks, housing index.
All right, that's a very good question, because during the next break that's coming up, I do want to be able to. I'm going to juggle around so I can get Larry's charts right back up again. Had fabulous charts on the New York Stock Exchange, bonds, and other things. So I will be doing that. But in the meantime, the XHBs, the Spider S&P Home Builders. Now this is very important. In the daily, it's made a peak D. In the weekly, at this particular point, I'm going to call it F. It could be a brand new peak A, but I can only tell you that the MACD is turning down, the stochastic's very weak, and it's a leg E in the monthly chart. And I've debated this, what to do, because in my opening call, subscribers have fantastic profit in one of the home builders. And I'm debating, take the profit and just put in a bid way under to start a new position, hold this as a core position, which is what I've wanted to do, and then add on dips. So I'll talk about that. In the meantime, I'm going to juggle around, and I'm going to be able to get Larry's charts right back again so that we can all see them. So, and Corn, we were looking at, yes, I'll be doing that. And we're talking about the home builders with Mike in New York, Basil Chapman sitting for Larry Pesavento. We'll be right back straight after this message.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of the money game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
X-Story Gold Mines, an NYSE Amex-listed company trading under the symbol XG, is slated to be the newest gold-silver producer in Argentina. X-Story is forecast to produce more than $250 million in bullion annually, beginning in 2013, at a cash cost of less than $200 for each ounce of gold produced. That forecast will make X-Story one of the highest margin operators in South America and a sector leader in the mining industry. X-Story has $50 million in its treasury, having spent over $60 million to date on drilling and engineering. The ultimate size of its Argentina discovery could be determined by year-end, as results from the 6 drills operating at the site are fully assessed. To find out more about X-Story Gold Mines and their exciting growth potential, click on their banner on the front page of TFNN.com or check them out on the NYSE Amex under the symbol XG.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Hi everyone, we're back. Basil Chapman, Dow's down 27, S&P's up 0.24, and we are on right now with, let me just move this away, and then we're going to get back to those charts. We're on with Mike looking at the XHB, which is the S&P Spider Home Builders ETF. Now, I have to be a little cautious here because of 2 reasons. One is the monthly chart is still very strong with the stochastic at 93% and the MACD expanding, but it is what I have to call a leg E for now, at least. Number 1. Number 2 is, and that's where you got to be careful in the Chapman wave. Number 2 is I have to call this a leg F or maybe a peak F in the weekly chart, and that's where you really have to be careful. But look at this chart pattern that's unfolding. This is the pattern that has that oval formation. That can turn out to be a sideways consolidation. As long as the technicals don't break down, that's the MACD and the stochastic, as long as the price doesn't close decisively below the 9-period moving average at 21.04, right now it's at 21.39, down 8 cents. So far I'm saying a cautious, the yellow light's flashing there, just like the Dow making leg E, got to be a little cautious there. Now look at this. The daily chart says peak D, still well within the upper 50% of this range that went from 19.92 back on the 10th of April to the high of 22.43. Hey, that's a really nice percentage gain, 10 to 11%. Now it's pulling back some. So I'm watching this closely. So the big question is, and you got a great question there. The question is, do I get out of the home builders now if I've got a profit, or do I keep it as a core position if I got in right, and do I add to it on dips, Or do I just get out and then put in a price? In this case, do I put in a price of, say, 20.30, the low of, 20.10 was the low on the 23rd, so somewhere just above that low, and somewhere below the low of the 10th at 1992, and say, hey, I'm going to give myself a 1.5 or something like that of grace, and I'll just get in at a lower price. I mean, that's really one's thinking. I'm going to do this. I'm going to say that if you're looking at this as a longer-term position, I would still hold out as keeping a core position. On a short-term trading position, I would say that if it breaks under 21.27, it's at 21.39. It's only 12 cents away. Certainly if it does it today, I would probably take something off, and that's something I would plan to add on any sharp retest of the lows of the 10th of April. So, Mike, I hope that helps you.
No, Basil, I was just thinking on the weekly, wouldn't that have to test the 200-day? You'd want to see that.
Well, that would be the next step.
And hold the 200-day, and that would give me confidence.
That's absolutely true, because what would happen is if it broke down and it didn't hold 19.70, then absolutely we'd be looking at the weekly chart saying, uh-oh, you've got a real problem here because your MACD will be down, stochastic will be down, and I have to watch that monthly chart really closely. But I only want to go one step at a time, because the 200-day is right at 1884. It sounds like it's not very much, but on a percentage basis, that would say that if this comes down, then the ITB, which is the U.S. construction, will really tank, and that also is questionable. Is this F or new B in the weekly chart and so forth? The monthly chart says don't think of getting out just yet because it's still very strong. I want to go one step at a time. Even the strength we're looking at today should not be there, in my opinion, in a full bear market. This should be, and the day's young, but it should be a triple-digit close to the downside. That would say to me, it's all over for now. Forget about going long. So, do you understand what I'm saying?
Yes, very much. Yep.
I just don't have the energy to the downside in areas that I would expect to have had today. So, thank you so much for calling. I hope that helps you.
Right.
Good. So now let's just do this, because we've got Larry's charts, and I do want to get to them. And I've asked Larry if he would post, if he's listening, if he can post some of the earlier ones, because for some reason I'm not able to pick them up right now. Again, I did before. His silver chart shows just it's just a beautiful work of art. There are a whole series of garters and butterflies. The butterfly, yeah. So now what I'm looking at is that this last leg down in silver says that if it was to pull back further, and I would have to say it's at 30.13. If it closes, silver is trading right now at 30.12. So if silver closed under 29.60 in the next 2 days, then you'd be looking at a pullback. That's I think that's 786 retracement would take you to the 28.54 area. So that's what we're looking at now. Let me just go back. I just want to see the bunch of charts that Larry set up. Larry, I'm not sure you're able to do that, but I'm going to ask you once again. Oh, there's another break. All right, in the break, Larry, if you don't mind sending me over just the T-bond chart, and we'll look at that with your work. I'm going to see if I can get it now. No, I can't get it. For some reason, I can't get it. I got it before. Okay, Basil Chapman singing for Larry Pesavento. We're going to talk some more commodities straight after this when we get back.
You've heard Tom O'Brien on the air, and you've always thought about trying out his newsletter, Market Insights. Well, now is the perfect time. For a limited time only, when you sign up for a 2-week free trial to Market Insights, we'll send you a free copy of Tom O'Brien's best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System. If you decide to cancel within the 2-week trial period, pay absolutely nothing and keep Tom's book as a free gift from us. Tom sends out his daily newsletter each morning by 9:30 a.m. with trade recommendations, including price targets and price stops. As recently as March 21st, Market Insights subscribers closed out a position for more than a 25% profit in just over 2 weeks. To get your 2-week free trial to Market Insights, along with your free copy of The Art of Timing the Trade, Your Ultimate Trading Mastery System, visit the front page of TFNN.com. Supplies are limited for this one-of-a-kind special, so act today and don't let this opportunity pass you by. Offer only valid for new subscribers. Has the current market volatility continued to stop you out of trades when temporary market spikes move against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the advantage of keeping your trades open even when the market temporarily spikes against you. Nadex's innovation has allowed them to come up with a line of unique short-term binary options that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the opening call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his opening call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his opening call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the opening call, a $64 value, visit TFNN.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Hi, everyone. Basil Chapman. Dow's now only down 11. S&P's up 221. I want to see this resiliency. I want to see stocks that we are still holding on the long side moving nicely up. I want to see the stocks that we have on the short side moving down. So far that seems to be working. We'll go straight to the T-bond chart that Larry has right here. I'm filling in for Larry today. Larry's out there, he's fine. It's just his voice he hasn't got his voice back. So I'm going to try to be his voice. And what Larry shows here on the T-bond daily is that there are the rally from the 0.38 low of 135.20 back in March has gone to the 0.76 level. It's kind of stalled there. And what's really important, just look, I love this because when I show my chart, I'm absolutely sure that Larry's looking at it and saying, oh, there's the Gartley, there's a butterfly, whatever it is, because he does this so often. It just pops right out of him. What's popping out of me right now is the pattern that I call the falling axe. Look, you see this decline? If you're looking at the charts, if you see this decline in bonds from the December low, this is the daily T-bond chart, and you're looking at the low that went to about the 135 area low at the 0.382 retracement. Look at the declining tops. Well, we are tempted today to break to the upside. If bonds break to the upside decisively, that says our stock market will be going down. I'm saying if. Why? We don't know. So I'm going to show you the chart pattern that I'm looking at. And what Larry is looking for is the TBT to come down. And I believe he's got a buy zone. I don't want to speak for him, but I know that he was looking at maybe in the 17s to the 16s area. So that's the inverse, the 200% short that Lehman 20-year T-bond fund. In my work, which would correspond with Larry's, is if bonds broke out and went decisively into the 144, especially if it went to the 145, 20, 30 second area, that would be above all the previous highs. Then that falling axis, hey, be careful. You can get a 1-to-1 extension to the upside. I always take it from the previous troughs because eventually it can go all the way from the breakout point, but I'm conservative, and that would say from the 135 level, that would be about 7 points, and that could take you to the 146. And yep, I asked Larry for the crude oil chart. And there's the crude oil chart, and the crude oil right now, let me get it to fit into the window that I've got. There we go. The crude oil has made almost a 100% retracement back to the 7.86. So it says major test in oil at 96 BBL, a beer barrel. All right. And what you did is you went to the 1618 upside spike that took you to the 110 area. And now what you've done is you've come in a straight line down. The force of this line says, in my reading of it, and I suspect Larry would agree with me, that if it breaks the left side low in the 95 area, I will go to my chart in a minute with I can see the prices a little bit better. I just wanted to show you Larry's work. It would say that if it closes underneath there, that's a big negative because then oil could have a bounce back into the arch. That's this arch formation. But then would have to do a retest of the lows or whatever the low is. And that says it could even go lower. That's number one. On a bounce level, I suspect that there's another pattern fitting up here. I'm not going to draw it in, but I think that there's another pattern fitting. And what it would say is that if crude oil spikes above 100.50, that the candle that we're looking at, that's the candle of 2 days ago, the candle of Friday, that's the candle you'd be looking at with 102.50 as major resistance. So that's the crude oil, and so far it's a negative chart pattern. I'm just going to do the crude oil right here, CLN. Was it M or N? N. And that says it made a peak E-top just before March. It was March the 1st at 111.49. It's gone to trough E, try to have that bounce. That's what Larry was showing. That's that, in this case, I'm calling it an arch formation, breakdown. It's gone all the way back. But in the bigger context, what we have is this right here. And what happened is it went below today. It went below the 97.05 level of the 2nd of February. And if crude oil, this is the July contract, closes, it's already tested the 200 period simple moving average, try to bounce above it. So far it hasn't been able to. 100.47 is absolutely key for me with that 200 period moving average. If it becomes resistance because it can only bounce a tad higher and it keeps pulling back, that's going to say that crude oil would have a chance of retesting the low of 93.45 back on the 16th of December. So I believe that kind of corresponds very much to what Larry was looking at. If Larry wants to just say yes or no, that'll be fine. Now let me look at this. I'll be looking to see what Larry says. That's the crude oil contract. When I'm looking at the weekly chart of the crude oil, thank you, Larry. Larry says 100%. That's a great privilege. Thank you very much. Then look at the cup formation in this crude oil. Now, when you're looking at formations that repeat, remember we were looking at fractals all the time. They happen in small chart formations, and that pattern can repeat in larger time frames. And look at this. The cup formation failed to get above 113.30. That's crude oil back on the 6th of May, the week of the 6th of May. It came down under the 200-period exponential moving average to that level I was talking about, 77.40. And it ran back in an equal amount of time. It actually, one bar less, failed by just about 2 points, let's call it 2 points, to break and retest that previous high. There was an inside wedge. That dashed line is what I call an inside wedge formation. That inside wedge formation says that if, this is my own interpretation, this is my own Chapman wave technique, it says if the price pulls back more than, I used to say a third, but now I've I made it a little different because a third still gives you the chance for a cup and handle, one of my least favorite patterns. But it says that if it breaks 50%, let's just have a look. If it closes under 50%, there's just a really good chance that not only will it do the 50%, but it's going to go all the way to the bottom of the cup and make a potential U formation. So look at this. Crude oil needs to, if crude oil this week closes under 94.63 on Friday, there's just a really good chance that it'll test the low of 93.45, 93.50 back in December. And then if it closes under that, 68.71 is the 200 period exponential moving average, and I would say, hey, there's a real good chance you could even go all the way back to the 77 level. But I'm going one step at a time. Friday, the close below 94.50 says the 94 is game for a takeout, and you should go down to the 91 area, maybe even the 88.70s. Now, that also talks to the economy. I believe it has to talk to the economy. So it means that on the upside, by Friday afternoon, if there's a great rebound, and the rebound takes it to the 102.52 is the 9-period exponential moving average. If Friday at 4 o'clock it closes above that, that saves the day, and all of a sudden you're looking at a potential for another cup formation. And I'll just draw it in here as a potential. That's all. So I wanted to go through that. Now let's go through something that I think is important, high-grade copper. I'm looking at the June contract. I don't know if people trade the June, but that's what I've got here. The June contract is holding the 200-period exponential moving average, but it's under the 3.736 9-period exponential moving average. The daily chart is very interesting. It made a peak seed, hasn't completely broken down, but it's all within the context of having lower highs and lower lows for the most recent period since February, since the February high. I don't like that, because all of a sudden you can draw in a down channel like that. You can draw the parallel like that. You can put it underneath, and you just have very clear parameters. On the upside, a takeout of high-grade copper, if it takes out 3.889, then that'll be very positive. But if you get the repellent zone, remember the Chapman wave, we have something called the repellent zone. It's this little inside track over there where the price keeps getting repelled, and it was repelled once again at 3.85 on the 1st of May. That says you can come down and you can test. This is the inside track support, so this will be green. And here's the inside track that it cannot break under. If it breaks under this, high-grade copper is going down and down steeply, and not only that, that'll correspond probably to crude oil and the markets. So this is a very important period we're looking at, because if high-grade copper, I'll give you the numbers, can get above 3.78, there's a good chance it's going to try to retest the 3.852 area, maybe even make a leg D up in that sell zone. But if it breaks down in the next 2 days and cannot hold this 3.60s, that would be not good at all. And that corresponds exactly to the weekly chart with that falling X formation. It's exactly the same thing. It either arches over, that's very negative, or it breaks out. So this is such an important period for so many of these charts. Now, let's do this. I'm going to swing around. I didn't even look to see. I had some emails while we were busy. No, I don't see anything. Okay, so the emails were like this. One person asked me about CAT and Caterpillar. Of course, I spoke about this on Friday, I believe, because I said CAT has to be looked at as a commodity play, really. I mean, after all, what the heck is it? So Caterpillar arched over, made a PD top in the Chapman wave at 116.95 back in late February. It's making that arch formation, lower lows, lower highs, gone under the 100.86 200 period exponential moving average. The stochastic is getting close to an area where it should rebound, but that weekly chart says, oh, there's nothing here that's positive, and the monthly has got the pattern that I call the Groucho Marx eyebrows. There's the eyebrow, left side, right side, there's the schnoz, comes back, and it's failing. That's a pattern. The V-shaped pattern is really what I have to look at and say, be careful. So here's what I'm looking at. Yes, this is general market as well. If Caterpillar, CAT, which is trading at 97.43, is down 1. If it closes decisively under 96 in the next 2 days, that weekly chart says be careful because it could test all the way down to the 88, 86 area. I'm just watching this so closely because it is part of, I call my Dow Quartet, General Electric, IBM, Triple M, and UTX, my Dow Quartet index or indicator. With the UTX is my pilot light indicator, but I also include Caterpillar and DuPont very often. So this Caterpillar chart is something I got to watch for. The DuPont chart has been way better. It's making a high level consolidation, and that DuPont chart, it also a commodities play, is at 52.83, only down 6 cents, having made a tremendous rebound. But unless DuPont by Wednesday afternoon, Thursday morning is up above 53.25. I got to say, whoops, be careful. It could be pulling back again. Now I'm going to ask Larry if there was a chart that I've missed that he wanted to look at. And while I ask him that question, the next question was, let's see. I got a question asking, hello there, hope you're well. Quick question. In your overview section, that's my opening call, it's my subscribers get every single day a very comprehensive look at the markets, the Dow chart. I showed a chart today which I consider to be really important. This chart right here. This is an alternative way of looking at, will I find it? Yeah, this is a 120-minute chart. And in yellow, you'll see what I've done is I've outlined what could in fact be a pattern that we've got to consider as a possibility. So the question is, you talk about a fractional lower high in April SPX chart is a technique, one that I'm not aware of, that now has been concerned if May does not give a new high bar. Please explain. Yeah, I made a mistake. I thought that the monthly chart of the S&P had made a fractionally lower high, but it didn't. If it had, I'd be concerned because that is a pattern that I've developed over, certainly over the last 6 months. I've spent a lot of time on this, and he has some stocks. Look, if you look at APA, I'm just checking to see if Larry had anything there. APA, this APA is Apache. Apache core. Now I used to have this all notated, but I lost it. This is BC. Okay. Now look at this high. The high was 134.13 in April of 2011. The very next month it went to 133.67. That's just 70 cents away. You can hardly see it. But that is a technique that I've been working on for some time. When the technicals are failing at that particular point, it's like saying, I don't have the strength on the upside. I couldn't even make a fractional new high. Here's another one, LMT, limited, is that limited or is that Lockheed? Lockheed Martin. Lockheed Martin makes 120.80 high on August of 2008, and then it goes to 119.95. It just couldn't get that fractional new high. Pow! It goes to the 200 moving average at 57.41, almost cut in half. So that's a technique I've been working on for some time, and I'll keep doing some research into that. I've got a whole bunch of, every single thing. Falling X, I've got dozens. I've got moving averages, the 9 to 200 period. I've got MACD, the fast moving average holding well. How it can keep you in a trade up or down. MACD deflecting lower. Low bar cannot also be the high bar. Leftover peaks, island reversals, instant restart, just a whole book of these things. Here, so let's just do this. This is Larry's show, so I wanted to go through. Larry does Trade What You See. Another chart that I wanted to look at, because Larry showed it earlier on, is the New York Stock Exchange. And you know that Larry talks about this because it's 2,000 stocks. It's a really important indicator. I'll show you what I'm looking at, and if Larry is still around, he's able to post it.
What you think about, you bring about. What you focus on grows. If you're committed to becoming an extraordinary trader and investor, then make mastery your outcome. Yes, my best student, Steve Rhodes, became my best teacher. But even more important is what he's taught me, and the time is now for you to take advantage of his knowledge.
Thanks, Tom. I've learned that it's not what we do once in a while that shapes our lives, but what we do consistently. I want to teach you the consistency that exists in the stock, futures, forex, and commodity markets day in, day out. For one solid day, Friday, May 18th, I'm going to conduct an online Master Trader course that'll teach you how to buy and sell the D point. This one pattern alone, with the single best entry and exit techniques, when combined with my money management strategies, classes will create extraordinary rewards for you and your family. The course will be archived so you can review it as many times as you'd like, and it'll teach you to become a master. All the details are on the homepage at TFNN.com. Sign up today because mastery is one click away. It's your decisions, not your conditions, that determine your destiny.
Wow! Go get them, folks.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks. Ken is a top-down investor who lets price and volume in the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today, click Investment Newsletters, and get Ken Shreve's Ultimate Growth Stocks free for 2 weeks.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Here's what people are saying about Tiger TV.
Let's go to John in Tampa. Hey, John, what's going on?
Hi, Tom. How are you, sir?
I'm doing great. You having a good day out there?
A wonderful day. I love your Tiger TV. I watch it every day. I'm like a kid in a candy store.
Oh, man, I appreciate you out there watching it. How long have you been watching the Tiger TV?
I'm watching almost a month now, and it's wonderful.
It's pretty cool, isn't it?
Oh, yes, it's cool. You see the charts and everything. Thanks so much for the hard work.
Tiger TV, a great news service from TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
For Larry Pesavento, just briefly, let me remind you, 2:10 this afternoon Eastern Time, CNBC. Brian Sullivan will be interviewing Tom O'Brien. Should be a fabulous show, as always, when Tom's on with it. Just it's terrific to see him there. I will be talking at the Investors Business the Boston Investors Group, and that is at MIT tomorrow evening at 7 o'clock. I'm not sure exactly what time I'm on, but you can just Google it, the Boston Investors Group. You'll find out all the information. It's just at MIT. Pretty easy to get to there, very easy to park, and I'll be looking forward to seeing you. Now, there are a couple of things. Just let me quickly finish up. I wanted to look, I'll talk about Facebook on Wednesday. I hope I can remember to do that. I wanted to just look at this, the diamonds. This is the Dow diamonds. I'm not sure if you can see it. I'm just going to check. That yellow patch over there, it shows that there's a down channel occurring in the 120-minute chart of the diamonds. It also has the left side, right side price time match. I've suspected that if there is a rally that fails, can't get over the 130.58 9-period exponential moving average in the next 2 days, starts to fail, we can make a series of lower lows, and then I'd be looking around about the 9th of May. I don't know what would be, today's the 7th. In another 2 days, we could be testing the 128.85 level. That means that any rally has to change this format completely. It has to turn around and go right past this down channel, the dashed line. It has to break above it to be able to show the force to say, hey, the rotation is still continuing. There are enough stocks to keep at least the Dow type index going higher. When we go to the New York Stock Exchange, you'll see this particular chart here. If you're looking at the this is way back when we were coming down in 2008. I call this Dinosaurus New Yorkus, and I drew that in because if I squash this chart, you'll see exactly what I was looking at. Had the long tail, had the big body and the neck. Anyway, what happened is it did come down, so it went to 44.18 back in 2000. Then 2003, it tested the 44.18 area successfully and went to peak A, peak B, D, a brand new ABCD to E at 10,387. This is the New York Stock Exchange. And then it plunged. It plunged down 59.7%, more than the S&P, down to the 41.81 level at 59.7% decline, a minus 59% decline. But look what's happened since then. You've had more than 100%. You've had 108% rally to 87.18. It's holding the up channel. It did have another one of those falling axis breakout, the declining cone. May has to close above 79.60. Because if it closes under that at 70, well, if it breaks the support of 7,400, that is going to be very negative. So I like Larry, I'm watching this real closely. 2,000 stocks, very important indicator. So that's that. And the weekly chart says it's still got the pattern that is either going to be an arch formation in the weekly, or it's going to somehow in the next 4 weeks, I'd say, break above 81.30. 83.99, get to the 8,400 area to start to try to get to leg D. This is going to be a very important couple, maybe 7 days in the NYA. 78.37 is absolutely key support that it has to hold. So I wanted to go through that. It kind of corresponds with what Larry was looking at, and the downside pressure, as far as he's concerned, I'm pretty sure would say that if it was to break down 75.93, to me that's the 200-period moving average, but under that 75.80 area, not good news at all. So let me just redefine quickly. The most important thing for me right now is the VIX index. That volatility index has pulled back very sharply from the day's high of 19.87. If the VIX index over the next few days gets under 17.80, certainly 17.50, market is able to rally. If it retests the highs and starts to get to the 21.5 to 22 area, watch out below. I'm making it as simple as that. And the dollar index, yeah, it's important for the dollar index, but the dollar index then would go to at least 80.50. Basil Chapman sitting for Larry Pesavento. I'll be back Wednesday morning with my usual show. Thanks for being here, and I hope I did some justice to Larry.